performance evaluation for revenue centers, cost centers, and profit centers is relatively straightforward. If a firm is evaluating a revenue center, it can compare the actual revenues earned to some predetermined benchmark. Or the firm can use flexible budget variances for revenues. The sales price variance is the difference between the actual price at which the goods were sold and the expected price times the actual quantity of goods sold. And the sales quantity variance is the difference between the actual number of units sold and the expected number of units sold at the standard price. In other words, assuming that there was no price variance. If a firm is trying to evaluate the performance of a cost center, it could compare total costs to some predetermined standard, or it could use flexible budget variances for cost. We learned in the previous chapter that the price variance for variable cost items is the difference between the actual price paid and the price that was expected to be paid times the actual quantity of that variable cost item that was used. And the quantity variance is the difference between the actual quantity used and the standard quantity that would have been expected to be used at the standard price. A key issue for cost centers is the controllability of a cost. It's important that managers only be evaluated for costs over which they have control. For example, a price variance for direct materials would be the responsibility of the purchasing department, whereas a price variance on direct labor would be the responsibility of the production department. By contrast, both the direct materials and direct labor quantity variances are the responsibility of the production department, because the production department manager has control over the amount of direct materials and direct labor that are used in production. Evaluating a profit center is a bit more complicated because the manager is not just responsible for earning revenues or controlling costs. This manager has to make sure that the revenues earned are significantly greater than the costs incurred. One way to evaluate a profit center is to look at revenues and costs, or total contribution margin, and compare these actual amounts to some predetermined benchmarks. Another way would be to use flexible budget variances, including the sales revenue variances and the cost variances that we looked at on the last few slides. Of course, the manager of a profit center should only be evaluated on revenues and costs that the manager can control. These would include direct expenses for the division that are traceable, as well as indirect service department charges that are allocated from, for example, the personnel department or the maintenance department, as long as the profit center manager has some influence over how much of these costs the profit center incurs. In the next section, we'll take a look at how to evaluate the performance of an investment center.